I would like to thank Bank of Lithuania for extending the invitation and for hosting the timely conference. I already learned a lot, and to see all the perspectives, often different, is very telling and enriching. Standard disclaimer applies, so when I sound provocative, it is only me, not the National Bank of Poland. I'll try to tell you three things: what has happened in Poland on the real estate market, what has not happened, try to provide a narrative why it has been so, and to offer some takeaways. So first, Poland has indeed, as many other countries, experienced a mortgage lending boom. Mortgages have increased from virtually non-existence to being the biggest part of banking books over a few years. This is the broad credit measure disaggregated into various components. Now, this surge from early 2000, where the mortgage loans have been expanding, was associated with rise in FX lending, which comprised more than 50% of lending to households, and it was particularly steep before the crisis. So we had mortgage market boom with FX lending, and this all coincided and helped to fuel real estate prices increases that really kicked off after the EU accession in 2004. Since within the few years, the prices have more than doubled across the country. We are looking at prices across a number of cities that you see on the right-hand side. The price levels differ across cities for many reasons. The dynamics that you see on the left side were relatively similar. So perhaps irrespective of differences in the dynamics, we would not do it before because of regional differences. However, we have been confronted with mortgage market boom, FX lending, real estate price increases. So it seems like a recipe for disaster. What you see here is the early warning indicator that we now use to guide us with respect to countercyclical capital buffer. It reflects signals from almost 200 models. The solid black line is the weighted average, and then there are distributions for let's say, more optimistic and pessimistic model. Then there is a threshold above which you should act, given the preferences towards type 1 and type 2 errors. So in late 2006, early 2007, we would have signals, should we have this tool, that something should be done. Now, we didn't have macroprudential policy at this time, and no countercyclical capital buffer. However, there was no crisis. Poland has survived the great recession, the great world recession, without having negative growth. We continue to grow and expand. There was no substantial increase in non-performing loans. So why it has happened that no crisis has happened? So one aspect is that the level of indebtedness in Poland continues to be relatively low by international standards, and we are still comfortably below many of the suggested speed limits that one could provide based on international experience. So there may be a fundamental factor that this was a financial deepening. Adding to this, the not necessarily widespread indebtedness has lessened the negative feedback loop between financial sector and the real economy during the downturn. So even when there were perhaps some increases in non-performing loans, they were not feeding strongly into the consumption patterns. Second, well, I thought what takeaways I can take from looking at price levels rather than only developments. So on one side, Poland, which is, this part slightly enlarged, and Poland is here. Well, this GDP per capita and price in euros per square meter in capital cities, downtown area. It's not easy to find, but private investors do have it, and they gather information that we provide, so central institutions. The color of the bubble indicates whether we have expansion, green, in prices over recent years, or contraction when it's white, and the size of the bubble indicates whether the magnitude. So Poland was, well, still low and relatively stable. I don't know what are the explanations for the big differences in level of prices across countries. Perhaps for financial stability purposes, it's enough that we concentrate on dynamics. But the discrepancies are big. And Monaco is not here. It's over 44,000 euro per square meter. Now, there was a degree of luck in terms of what happened with FX loans. On the left-hand side, you see the pattern of Swiss franc exchange rate relative to the zloty. This is green line. And interest rates in Switzerland. The two have negative dependence, and therefore, given the fact that Polish households have been taking loans that were with variable interest rates, the two risk factors partly offset each other. And on the right side, you see what is the degree of increase in debt service relative to the nominal of the loan, which was around 7.5 for hypothetical standard loan in just before the crisis. And it has increased by around 30%. But should it be fixed interest rate, like it was in Hungary, it was more than double this increase. So whether that was, did we know it? No. It was basically a bit of luck. But, well, last but not least, you can help luck a bit. So even though we did not have macroprudential policy, microsupervision took actions that were at heart macroprudential. Three types of actions. One, there was a substantial tightening on risk weights. So rather than having struggling with risk rate for mortgages of 5 or 10 or 15%, that is the EU average, it was more like 50, 75 or 100% for FX loans. So this was one type of measure. Second, through recommendations, we have introduced first debt service to income limits. That is not necessarily a binding law, but in reality very much observed by supervised institutions, but then subsequently abolished it. And I'll come back to it on the desirability on introducing debt service to income ratios. And more recently, we have been increasingly strict regulation concerning LTV, which is now there is recommendation at 80%. Now, and the FX lending basically stopped, partly because of the measures taken, partly because of the moral suasion where the supervisors have been suggesting to the banks that this has negative effects, both to monetary policy, so there are negative externalities to monetary policy, and to the extent you believe it's desirable to have an independent monetary policy, FX loans are detrimental to the effectiveness of monetary policy. And second, externalities due to risk of financial crisis. Banks have virtually stopped giving new loans, both due to moral suasion and to the crisis that made them realize how fragile the FX financing might be. So, and in the end, in per annum terms, the stock of credit decreases by 7%. And there are no big problems. So what are the takeaways that I would like to offer you now? There are two main. First, there is a question, there was a part of luck, but we can help luck. Now, the question is how active should we be in terms of the deciding on how active macroprudential policy should be. One of the most common instruments is debt service to income or loan to value. And there is a question to what extent macroprudential authorities should interfere with lending practices. You might have seen research that shows that these instruments, debt service to income, affect credit. Well, I would say that this is, from macroprudential perspective, both obvious and irrelevant. Obvious because should you put it at 1%, would you not believe that there would be a very strong impact on credit, that there would be virtually no credit? And if you put it at 80%, there would be no impact at all. So it's not the question of whether there is an impact, but what is the impact of particular level. And most of the studies do not have the granular information of the level. It's simply the binary variable, yes or no. It's irrelevant because it is not the pace of growth of credit that we want to affect. If this is the target variable that we want to have, then it's more natural to have a credit limit, and we have it solved right away. The true idea behind debt service to income ratio is to eliminate over-indebted households from the market. Now, how to you can eliminate them all by setting the limit at 0%. Obviously, you will eliminate all others at the same time. So how to set it? We have provided a framework, an idea for a framework, that debt service to income ratio basically divides the population into two subsets. Presumptively over-indebted ones, above, and non-over-indebted ones. So one can compare how these two subsets look like against other measures of over-indebtedness. So we have taken one, let's call it objective measure, that comes from detailed wealth survey and micro-simulation based on the wealth survey, and self-assessment of the households. And we've seen that, indeed, debt service to income has the probability of correctly putting the households in two brackets with probability of 70%, which is a lot or not that much, depending on the point of view. Now, second issue is that there are two types of errors that you would make. One is that you say he is over-indebted or she, and indeed it is not the case. So you take away someone from the credit market. And the other one is that you let someone pass who is indeed over-indebted. Type 1 and type 2 errors. Now the question is, which one is more important? I believe that more important error is the one that you constrain someone who should not be constrained, because this is the final decision. However, if you let pass, the bank themselves still have obligation to evaluate the credit worthiness. So is the second backstop. Therefore, the first type of false positive, type 1 error, should have higher weight. Now, these are the optimal debt service to income limits that we found based on the micro-simulations and self-assessment, given set of preferences, and 1-to-1 is equal, both type of errors are the same, and here that we say that taking someone from the market that should not have been taken is more costly. Well, depending whether you're a Ministry of Finance or a central bank, and you can decide which preference is yours. However, what we have found that it's not that comfortable. For 1-to-1, it's around close to 40%, fine. However, once the preferences are not 1-to-1, there is big ambiguity whether what's the right level first, and whether the level itself should be introduced at all. So this is one. Second takeaway, we have discussed the interlinkages between micro and macroprudential supervision. However, what I think is very important to ensure financial stability is the third pillar, consumer protection. At the heart of many financial crises, perhaps most of them, is mis-selling of financial products. So being over-indebted not realizing what are the risks entailed. While and consumer protection can help in safeguarding financial stability where supervisors cannot. On the one hand, it can screen the lending practices to the extent that supervisors would likely not. Because once as micro or macro supervisors would see big profits in banks that provide a cushion against adverse shocks, we will be likely comfortable. And there is a question, to what extent would we, at the right time, understand that this is due to selling of products that are not necessarily tailored to the need of customers? In our research on early warning indicators, we have actually seen that high increases in value added of the measured value added of the financial sector is a harbinger of crisis. So it is rather taking on excessive risk that provides rents and profits to the financial sector rather than productivity gain. And this is not necessarily sustainable. So consumer protection can help in screening what banks indeed do at the very front with respect to clients. And second, given the perhaps big changes due to fintech that we observe and might observe in the near future, consumer protection agencies are perhaps best positioned to monitor the emergence of new lending channels. And think about Airbnb, Uber, how much they have changed their respective industries within few years. And there is a question how much it can be changed in the banking business. When you go to the banking conference in private sector, fintech is all they talk about. Banks want to become fintech companies. Perhaps they will become, but perhaps some other will. The challenge for the supervisor is perhaps then to answer the question, can we or can they tell the difference between innovation and something harmful? And it will be a difficult decision. Now, concluding, we have been lucky. We have tried to help our luck by being prudent, and this was not necessary. Did not necessarily imply that banks had problems and thin profits. The return on equity was very high. The profits were still high. So it's often a puzzling question how banks can, in some cases, survive with apparently relatively stringent rules and thrive, and in other places no. Now, the takeaways from financial stability, I would say that I like the motto from medicine, primum non nocere, so that we truly weigh the costs and benefits. And while I see that the benefits, at least in a narrative, are easy to provide after the crisis, I do not see the true cost analysis of the measures taken. And there is indeed risk of inaction bias, but I often wonder what is the risk of overreach by macroprudential authorities in terms of trying to be more than they can, eliminating too much of what is to be eliminated. Thank you very much for your attention.